Have you ever wondered how some individuals or maybe businesses legally navigate the really complex world of global finance?
Ah,
To significantly reduce their tax liabilities or even protect assets across borders.
hmm.
It's a truly fascinating subject, often quite misunderstood, actually.
It really is.
So today, we're diving deep into what are called tax-efficient jurisdictions, though many people just know them as tax havens.
Right.
And our mission really is to unpack what makes these places tick, from their specific tax benefits and clever revenue models to the features that really set them apart.
Exactly. And I think it's crucial to understand right from the start, this isn't just about places slapping a low tax label on themselves.
Okay.
The world's leading tax-efficient jurisdictions, they actually combine things like political stability, really robust legal frameworks, strong financial privacy, and increasingly a commitment to international compliance.
Right. Compliance is key now.
Absolutely. So we're exploring the entirely legal pathways that individuals and entities use to manage their financial obligations effectively. We'll be looking at the top 10, discovering what truly distinguishes each one, from, serene Caribbean islands to these vibrant financial centers in the Middle East and Asia.
Okay, let's unpack this then. When we talk about tax havens, it's clear it's not just a blanket term for zero taxes everywhere. It sounds like a sophisticated blend of factors.
It is.
So what exactly are the core definitions of these, let's say, leading jurisdictions? And, where do we even begin to categorize them?
Well, at their very core, these are places meticulously designed, really, to offer legal avenues to significantly reduce, or in some cases, entirely eliminate certain tax liabilities.
Deliberately designed.
Yes, exactly.
Yeah.
They do this by combining low or zero direct taxes with a very strong financial infrastructure and, crucially, unwavering political stability. It's a deliberate strategic design, the aim, to attract global capital and businesses.
That deliberate design to attract capital is really fascinating. So when we talk about leading jurisdictions, how do we even measure that or compare how effective they are? Is there like a framework?
Absolutely. The jurisdictions we're discussing, they're often ranked by what we could call their tax benefit levels.
Tax benefit levels, okay.
Yeah, and this isn't just about the tax rate itself. It's a comprehensive look at the overall advantages they offer, how they actually generate their government revenue, if not through direct tax, the regulatory environments they maintain, and any sort of specialized programs that enhance their appeal.
Got it.
It gives us a clear, structured way to approach this deep dive.
Okay, here's where it gets really interesting then. Coming in at number one, and, well, arguably the most comprehensively tax-free jurisdiction out there, we have the Cayman Islands. What makes them stand out so much to get that top spot?
Right, the Cayman Islands. They're a British overseas territory located in the Western Caribbean and genuinely a world-class financial center. When you look at their direct tax benefits, it's quite striking.
How so?
There's no personal income tax, no capital gains tax, no corporate tax, no wealth tax, and no inheritance tax.
Wow.
They truly operate with zero direct taxes on individuals or entities. Doesn't matter if you're resident or not. It's almost like a blank canvas, for financial structuring.
That concept of a blank canvas is powerful. But, okay, if there are no direct taxes,
Right.
how does the government fund itself? Infrastructure, services, maintaining that stability you mentioned.
Ah, that's the clever part of their model. Their revenue relies heavily on things like import duties, which can actually go up to 25%.
Okay.
Then there are work permit fees, various tourism-related fees like departure taxes, hotel taxes, and licensing fees for businesses, especially the financial entities based there.
Right, the financial sector must be huge.
It's incredibly robust. They host literally thousands of investment funds, major international banks, multinational corporations. They operate under a stable common law legal system, and the Cayman Islands Monetary Authority, CIMA, ensures very strong regulatory oversight. Key sectors: investment funds, private equity, banking, trust services, insurance, reinsurance.
So it's that combination.
Exactly. This sort of unmatched neutrality for wealth preservation and corporate structuring is precisely what puts them at number one.
That's an incredibly clear picture of how that neutrality works as an economic strategy. Okay, so what's right on its heels? Number two.
Just a very, very close second, we have the Bahamas.
Ah, the Bahamas. Known for tourism, right?
Definitely renowned for tourism. It's this breathtaking archipelago, over 700 islands in the Atlantic. but it's equally known for its sophisticated offshore finance sector.
And tax-wise, similar to the Caymans.
Very similar.
Yeah.
Much like the Caymans, the Bahamas offers no personal or corporate income tax, no capital gains tax, no inheritance tax, no wealth tax, no estate tax, and no gift tax.
So complete exemption again.
A complete exemption from direct taxation, yes. Which makes it similarly appealing, of course.
Okay, so with those broad exemptions, how does the Bahamian government raise its money then? Must be a slightly different mix.
It is, slightly. Their funding primarily comes from import duties, stamp taxes, particularly on property transfers, licensing fees, and various excise taxes on things like fuel and tobacco.
I see.
They also boast quite modern banking laws that protect client confidentiality. And like the Caymans, they operate under a British common law framework. That adds a layer of legal predictability people value.
And their financial services.
Pretty extensive. You've got offshore trusts, foundations, international business companies, the IBCs, and a strong presence of international and private banking. It's really that combination of complete direct tax exemption and strong privacy safeguards that places them so high, right up there at number 2.
So a similar appeal, strong privacy. Got it. What makes Bermuda then at number 3 slightly different? It has a very specific reputation, doesn't it?
It does. Bermuda, located out in the North Atlantic, has very carefully carved out a specific and frankly dominant niche. It's the premier global hub for reinsurance and insurance.
Ah, the insurance angle.
Exactly. In terms of direct tax benefits, it aligns pretty closely with Cayman and the Bahamas. No corporate income tax, no personal income tax, no capital gains tax, no inheritance tax, and importantly, no taxes on worldwide profits or dividends for companies structured there.
Okay, that sounds incredibly similar to the top 2 again. So what's the catch? What's the distinguishing factor in Bermuda's revenue model that puts it at number 3?
The key difference lies in how they fund their government. While they certainly rely on import duties and licensing fees like the others,
Yes.
they also implement a payroll tax. And this is shared by both the employer and the employee. Plus, there are social insurance contributions.
Ah, payroll tax. That's the difference.
That's the main difference. This payroll tax makes it, let's say, a fraction less neutral in terms of all direct taxation compared to the Cayman Islands or the Bahamas. But despite that, Bermuda is home to many of the world's largest reinsurance firms. And the Bermuda Monetary Authority, the BMA, enforces exceptionally robust anti-money laundering AML standards. So they balance that openness with rigorous global compliance. Its leadership in insurance really keeps it firmly in 3rd place.
That payroll tax is definitely an interesting distinction, shapes its profile. Okay, from Bermuda's specific landscape, let's pivot slightly. The British Virgin Islands, number 4, often heard as the go-to for setting up companies quickly. What makes the BVI such a consistent stalwart in the offshore world?
The British Virgin Islands, or BVI, yes. A cluster of Caribbean islands that are almost, synonymous with easy company formation and flexible trust structures.
Yeah.
Their tax benefits. Pretty comprehensive.
Like how?
No capital gains tax, no inheritance, gift, wealth, sales, or income taxes for corporations or individuals.
Okay.
And crucially, absolutely no tax on the offshore profits of BVI-registered companies.
So, if those offshore profits are untaxed, what's their main source of government income, and what makes that easy company formation so appealing? Is it really that fast?
Government income in the BVI comes mainly from company registration fees, the annual license fees those companies pay, and work permit fees for people working there.
Right.
And yes, on the corporate structuring side, they offer remarkably simple incorporation procedures. Often, you can get it done within 24 hours.
Wow, that's fast.
It is. They also provide strong confidentiality. Beneficial ownership information isn't publicly disclosed. Now, that level of privacy might, raise an eyebrow for some.
Potentially.
But the BVI is a signatory to numerous tax information exchange agreements, TIAs, and is firmly committed to OECD and FATF standards. They demonstrate dedication to international cooperation.
So they balance privacy with compliance.
Exactly. It's this unique blend of zero direct taxes and that exceptional ease of use that has made them such a stalwart for decades.
That ease of use is certainly a compelling factor for many. Okay, shifting gears now to the Middle East. The United Arab Emirates, the UAE, comes in at number 5. What's fascinating here is its unique blend, sort of traditional principles meets modern tax approaches, especially with its rapid rise in global finance.
Absolutely. The UAE, with vibrant hubs like Dubai and Abu Dhabi, has become an undeniable magnet for global business, tourism, and high net worth expats.
And the tax situation for individuals?
Very attractive. No personal income tax, no capital gains tax, no inheritance tax, and no wealth tax.
Okay, pretty clear. What about businesses? I heard they introduced a corporate tax.
They did. A 9% corporate tax came in 2023.
Yeah.
But, and this is the key point, it applies only to profits exceeding 375,000 AED.
So there's a threshold.
A significant threshold, meaning a vast number of small and medium-sized businesses remain entirely exempt from corporate tax. They also have a relatively low value-added tax, VAT, at just 5%.
So a corporate tax exists, but it's targeted, and for many, effectively zero. How does the UAE generate its substantial revenue then, given these exemptions?
Their main revenue sources include that VAT collection, the corporate tax from companies above the threshold, customs duties, and various license fees for businesses.
And the business environment itself. I hear a lot about free zones.
Yes, the free zones are a major draw. Places like DNCC or JFZA, they offer things like 100% foreign ownership, no import-export duties, and often additional tax holidays.
Right.
Add to that world-class infrastructure, a strategic location linking east and west. It's very appealing. And it's incredibly popular with expats. Think around 240,000 British expats live there, drawn by the tax-free salaries and the lifestyle.
Yeah.
So this near-zero personal taxation combined with the very low threshold corporate tax really positions the UAE as the leading Middle Eastern tax-efficient jurisdiction.
That's a truly compelling package, especially with the expat draw and those free zone benefits. Okay, what about Monaco? Number 6. It's always associated with luxury, exclusivity, James Bond territory.
Yes, very much so.
But what does that elite status really mean for its tax benefits, and who is it actually designed for?
Monaco is tiny, just 2 square kilometers on the French Riviera. And yes, absolutely synonymous with luxury casinos, elite residency. For its residents, essentially, there's no personal income tax.
No income tax.
With one notable exception. French citizens who settled there after 1963 are, under a specific treaty, still subject to French income tax.
Okay. An important exception.
It is. But for others, there's also no wealth tax or inheritance tax for non-French residents. Now, corporate tax, that only applies if over 25% of a company's turnover is generated outside Monaco. And then it's at a rate of 33.33% on profits.
Right, so quite specific conditions for corporate tax. If personal income tax is largely absent for most residents, where does Monaco's money come from? Maintaining that opulent lifestyle can't be cheap.
No, indeed. Monaco's revenue is largely derived from real estate transfer taxes, tourism, especially huge casino revenues and hotel taxes and VAT. Their VAT is 20%, and notably, it's shared with France under their agreements.
Interesting.
The lifestyle and mobility factors are a huge draw here, obviously. High-end real estate, a residence by investment program, often via property purchase, which offers visa-free access to the Schengen area.
So it's lifestyle package.
Very much so. While the zero personal tax and luxurious lifestyle are key, those restrictions for French citizens and its more limited corporate neutrality are factors that position it slightly behind the UAE for, let's say, broader business appeal.
The luxury angle definitely defines Monaco. Right, let's head back to the Caribbean for number 7. Antigua and Barbuda. What special program elevates this dual island nation into our top 10?
Antigua and Barbuda in the Eastern Caribbean. Beautiful beaches, yes, but also known for their pioneering Citizenship by Investment program, or CIP.
Citizenship by investment and the tax side.
Also very attractive. No personal income tax, no inheritance tax, no capital gains tax, no wealth tax. And for non-resident companies, importantly, no tax on worldwide income. That's a significant advantage.
And how does that Citizenship by Investment program actually work? And how does it contribute to their revenue and global appeal? A second passport is a huge deal for global mobility.
It absolutely is. The government's revenue model includes the usual import duties, tourism levies, but critically, significant fees generated from the CIP.
How does one qualify?
Individuals who make a qualifying contribution, usually to the National Development Fund, or invest in approved real estate or specific business projects, can gain citizenship.
And the benefit?
Visa-free access to over 140 countries, which is substantial. And for the new citizens, they get full domestic tax privileges within Antigua and Barbuda. They also maintain flexible trust laws and confidential company registration.
So it's that combination.
Exactly.
Yeah.
It's this powerful blend of zero direct taxes and the robust CIP that puts them 7th. Ideal for mobile entrepreneurs, investors seeking that enhanced global mobility and financial freedom.
A second passport is definitely a major draw. Okay, Panama at number 8. Famous for its canal, obviously, a major logistics hub. But what does its territorial tax system actually mean for individuals and businesses?
Right, Panama. The bridge between North and South America, the canal, logistics, and yes, its territorial tax system. This is the key differentiator.
Territorial tax, meaning?
It means only income earned within Panama is subject to tax. For corporations, that's generally a 25% rate on Panama-sourced income. But income earned outside Panama, offshore-sourced income, is generally not taxed, either for individuals or for corporations.
So if your business is international and the income comes from outside Panama?
It's typically tax-free in Panama. Also, there's generally no capital gains or inheritance tax on foreign source assets.
Okay, that's a crucial distinction. How does Panama fund itself then?
Primarily through taxes on that domestic corporate income, VAT, which is relatively low at 7% import duties, and of course significant revenue from the Panama Canal tolls.
And structures, privacy.
They're known for swift formation of corporations, SAs, and private interest foundations, which are quite unique vehicles. Historically, privacy was very strong, though they've made significant compliance upgrades recently. There's no public registry of beneficial owners, but they are now a signatory to the OECD's Common Reporting Standard, CRS, and adhere to FATF recommendations.
So adapting to global standards.
Definitely. The key benefit remains that territorial system, combined with robust corporate vehicles, especially appealing for those whose revenue streams are primarily non-Panamanian.
That distinction between local and foreign income is crucial indeed. Okay, next up, Saudi Arabia at number 9. You mentioned it's an emerging player. What does its ambitious Vision 2030 mean for its tax landscape, and why is it making our list now?
Saudi Arabia is genuinely undergoing a massive economic transformation under Vision 2030. The goal is to diversify the economy away from just oil and actively create a low-tax environment to attract both talent and foreign investment.
Okay, and how does that translate into actual tax policy?
For individuals, it's very straightforward. No personal income tax on wages or salaries whatsoever.
Zero personal income tax.
Correct. For corporations, it's a bit more nuanced. Saudi-owned businesses typically face a 2% zakat, or corporate tax, while foreign-owned companies generally have a flat rate of 15% on profits.
That's quite a difference between domestic and foreign-owned entities.
Yeah.
What's the main source of their vast national revenue then, given the zero tax for individuals?
Predominantly, still, it comes from those vast oil royalties. However, they also rely significantly on VAT, which is currently at 15%.
Higher than the UAE.
Yes. Plus excise taxes and the corporate tax levied on larger enterprises, particularly foreign ones. They also host a huge expat population, over 13 million people. Their ICMA system, the Residence and Work Permit, ties legal status to employer sponsorship, and the associated fees contribute significantly to state coffers.
And Vision 2030 is driving investment.
Massively. There are substantial investment incentives in huge futuristic projects like NEOM and the Red Sea developments, plus growth in tech, entertainment, all backed by ongoing infrastructure build-out and regulatory streamlining. So it's really an emerging haven. Zero personal tax, competitive corporate rates, blending that economic dynamism with tax efficiency.
The dynamism and sheer scale of Vision 2030 are incredibly clear.
Okay, finally, rounding out our top 10, we have Singapore at number 10. Now, Singapore doesn't really claim zero taxation across the board, does it? So what makes it a top-tier choice?
That's right. Singapore truly stands out as a leading Asian financial hub. It masterfully blends an impeccable regulatory reputation with a highly attractive tax framework, even though, as you say, it's not blanket zero taxation.
So what are the main attractions, tax-wise?
For residents, a big one is no tax on capital gains or dividends.
Okay, that's significant.
Very. Personal income tax is progressive, but it's capped at a reasonable 22%. Corporate tax is a flat 17% rate, which sounds higher than some others we've discussed.
It does, but with incredibly generous partial exemptions and startup incentives. The effective tax rate for qualifying firms can actually be as low as 4.25%.
Wow, okay. Effective rate is key.
Absolutely. And foreign-sourced income is often exempt if it's remitted under certain specific conditions, usually tied to having been taxed elsewhere already.
So it's not about zero tax, but a very strategic, low rate, and potentially complex system. How do they generate their robust national revenue then? And what else contributes to its top-tier status?
Singapore's revenue model includes their goods and services tax, or GST, that's set to be 8% soon, I believe.
Right.
Along with corporate and individual taxes, significant income from land sales, and various licensing fees.
Yeah.
Beyond tax, they offer excellent wealth and business services, major family office incentives, the Global Investor Program, GIP, plus an extensive network of double tax treaties, and truly world-class legal and financial infrastructure.
And reputation.
Yeah.
Compliance.
Impeccable. Critically, Singapore has a stellar global reputation. Fully compliant with OECD and CRS guidelines, robust anti-money laundering regimes, strong intellectual property protection, it's seen as very stable, very legitimate.
So it's the whole package.
Exactly. With this unique combination, low effective rates, transparency, exceptional ease of doing business, and being a highly respected, stable, long-term jurisdiction. That's what firmly secures its place in the top 10.
So what does this all really mean for you, our listener? We've journeyed through 10 very different jurisdictions, haven't we? Each compelling in its own way. Each offers this unique blend of tax benefits, different regulatory environments, even lifestyle perks.
And what's truly fascinating, I think, is the sheer diversity we've uncovered. There's clearly no single one-size-fits-all tax haven anymore, if there ever was.
Right.
Some prioritize that full tax exemption we saw in the Caymans or Bahamas. Others focus more on asset protection, like maybe Panama with its foundations, or global mobility, like Antigua with its CIP, or like Singapore, offering a highly regulated, completely legitimate environment with attractive rates.
So it really depends on what someone is looking for.
Exactly. What's clear is how these places are constantly adapting. The era of just, zero tax seems to be evolving into one of intelligent legal frameworks, strategic niche markets, and increasingly robust compliance. That really seems to be defining the future of global wealth management.
Which raises, I suppose, the crucial question for anyone listening and considering these options. How do you navigate this really dynamic landscape? How do you ensure you're fully compliant while still achieving your specific financial objectives?
Well, choosing the right jurisdiction, it really does depend entirely on your unique goals. Is it full tax exemption you need? Or is it more about comprehensive asset protection? Maybe enhanced global mobility is the priority. Or perhaps operating within a highly regulated, legitimate environment like Singapore is most important for your business.
So step one is clarifying the goal.
Precisely. And then, our most important piece of advice, always, is to consult with specialized legal and tax advisors. And not just anywhere advisors in both your home country and to the host jurisdiction you're considering.
Both sides, that's key.
Absolutely essential. This is the only way to ensure full compliance with all the applicable local laws, international regulations, reporting requirements, everything. It gives you peace of mind and clarity.
Makes sense. The world of international finance and taxation is just incredibly dynamic, isn't it? Constantly evolving. Understanding these nuances, as we've tried to do today, is absolutely key to making informed, strategic decisions.
Couldn't agree more.
All the best, and we will meet again with another important subject in the next meeting.